Today we're diving into ESG investing, that's environmental, social, and governance investing. It's all about putting your money into companies that care about the planet, treat people fairly, and run their business ethically. ESG investing isn't just about doing good, it's also about smart, sustainable growth. I'll explain why this approach is gaining huge momentum and why it could be a game changer for your portfolio and the future of investing. Today we will talk about what is ESG investing and why it matters. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding ESG investing. ESG investing refers to the integration of environmental, social, and governance factors into investment decisions. Unlike traditional investing, which primarily focuses on financial returns, ESG investing evaluates how companies perform in areas such as environmental sustainability, social responsibility, and corporate governance practices. Environmental criteria examine a company's impact on nature, including its carbon footprint, waste management, and resource use. Social factors assess the company's relationships with employees, customers, suppliers, and communities, focusing on issues like labor rights, diversity, and human rights. Governance covers company leadership, executive pay, audits, internal controls, and shareholder rights. Investors use ESG criteria to identify companies that are not only financially sound but also ethically responsible, promoting long-term sustainable growth. This approach seeks to minimize risks related to environmental damage, social controversies, or poor governance, which can affect a company's profitability and reputation. As global awareness of climate change and social equity rises, ESG investing has emerged as a strategic tool to align capital with values and foster positive societal impact. 2. The evolution of ESG investing. ESG investing has evolved over decades, building on the foundation of socially responsible investing, SRI, from the 1960s and 1970s. Initially, investors excluded companies involved in tobacco, alcohol, or weapons from their portfolios due to ethical concerns. However, ESG goes beyond exclusionary screening by actively incorporating sustainability metrics and company performance in these areas. The term ESG was formally introduced in a 2006 United Nations report titled "Who Cares Wins?", which argued that embedding ESG factors leads to better financial markets and sustainable economies. Since then, institutional investors, asset managers, and regulators have increasingly embraced ESG frameworks. The rise of global initiatives like the Principles for Responsible Investment (PRI), Task Force on Climate-Related Financial Disclosures (TCFD), and the Sustainable Development Goals (SDGs) have further propelled ESG adoption. Technological advances, data availability, and sophisticated ESG rating systems have enabled investors to analyze and compare companies effectively. 3. Environmental criteria in ESG. The environmental component of ESG focuses on how companies manage their impact on the planet. This includes their policies and practices regarding climate change, carbon emissions, energy use, pollution, water scarcity, and biodiversity. Investors scrutinize a company's carbon footprint and efforts to transition to renewable energy sources. Companies with aggressive sustainability initiatives, such as reducing greenhouse gas emissions or committing to net zero targets, are often favored by ESG investors. Environmental risks such as regulatory changes, natural disasters, or resource depletion can pose material threats to companies, affecting long-term viability. For example, fossil fuel companies face increasing scrutiny as the world shifts toward cleaner energy, potentially impacting their profitability. ESG metrics in this domain might include emissions intensity, waste recycling rates, and use of sustainable materials. As climate change intensifies and regulatory frameworks tighten, environmental considerations have become critical in assessing corporate risk and opportunity, making this an essential pillar of ESG investing. 4. Social criteria and its growing importance. Social criteria evaluate how companies manage relationships with employees, customers, suppliers, and communities. This dimension emphasizes human capital management, workplace diversity and inclusion, labor rights, employee health and safety, data privacy, and community engagement. Socially responsible companies tend to foster positive work environments, fair labor practices, and contribute to social equity. Companies that neglect these areas may face reputational damage, legal risks, or disruptions due to poor employee morale or consumer boycotts. The rise of social activism and consumer awareness has heightened scrutiny on issues such as racial and gender equality, human rights in supply chains, and product safety. 5. Governance, the backbone of ESG. Governance refers to the systems and processes by which companies are directed and controlled. This includes board composition, executive compensation, shareholder rights, transparency, audit quality, and ethical conduct. Good governance ensures accountability, reduces risks of fraud or corruption, and aligns management actions with shareholder interests. Investors look for independent boards with diverse expertise, transparent reporting practices, and fair treatment of minority shareholders. Poor governance can lead to scandals, financial misstatements, or regulatory penalties that significantly impact a company's market value. Corporate scandals like Enron and Volkswagen highlight the dangers of weak governance. Governance also involves assessing how companies handle lobbying, political contributions, and conflicts of interest. Strong governance practices foster trust among investors and stakeholders, making companies more attractive for long-term investment. 6. Why ESG investing matters to investors. ESG investing matters because it offers a framework to identify risks and opportunities that traditional financial analysis may overlook. By integrating ESG factors, investors can better assess a company's long-term sustainability and resilience. Numerous studies have shown that companies with strong ESG profiles tend to outperform their peers in financial performance, risk management, and stock price stability. ESG investing also addresses growing investor demand for responsible capital deployment, driven by ethical values and societal concerns. Millennials and institutional investors increasingly prefer portfolios that generate positive environmental and social impact alongside financial returns. Additionally, regulatory bodies around the world are introducing ESG disclosure requirements, pushing companies to be more transparent and accountable. ESG investing supports the transition to a low-carbon economy, social justice, and improved corporate governance, aligning capital markets with global sustainability goals. 7. Challenges and criticisms of ESG investing. Despite its benefits, ESG investing faces challenges and criticisms. One major issue is the lack of standardized metrics and reporting frameworks, leading to inconsistent and sometimes misleading ESG ratings. Companies often self-report ESG data, which can vary in quality and comparability. Greenwashing, where companies exaggerate or falsely claim ESG credentials, undermines investor trust. Additionally, ESG investing can sometimes prioritize values over financial returns, raising debates about performance trade-offs. Critics argue that ESG funds may exclude profitable sectors or companies unfairly. Moreover, ESG investing faces complexity in balancing different stakeholder interests and navigating cultural or regulatory differences across regions. The diverse interpretations of what constitutes good ESG practices complicate decision-making. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.